show their revenues and their expenses. What is the consolidated net income for 2015? So let's go back and look at this. How do we figure it? We need to first start and show, let's determine the fair value versus the book value to determine those excess numbers, okay? So the fair value is the 540 plus the 60, right? Right? See the 60? It's showing the acquisition fair value and the 540. So if you look at it this way, I'm going to pull up a spreadsheet. They give you so much information it almost gets overwhelming, but you just have to break it down the way you know to break them down. So we need to first start at 100% of the fair value. 100% of the fair value is going to be the consideration by the parent, was 540. Then, do you see here it tells us the acquisition date fair value of the non-controlling was 60? See how it gives us that? So we're going to add acquisition fair value of NCI 60. Okay? So the total fair value is going to be the 600,000 here. Okay? Now, it told us what the book value was. $420. Star's net assets had a carrying amount of $420. So the book value of the assets, $420. What does that give us excess? 180. Then it tells us certain allocations. Didn't it tell us the equipment 8-year remaining life was undervalued by $80,000. So isn't part of this equipment for $80,000? And it has a 10 or 8-year useful life. 8. So we have to divide that by 8 years, which is basically $10,000 a year, right? It also gave us a customer list. How much did it say that customer list was? Customer list with a 4-year life. What is our remaining excess? Whoops. Shoot. This was equipment of 80. So our customer list is going to be the difference of that minus that, or 100,000. This had a 4-year life. What do we have to amortize this each year? 25,000? Does that make sense? So don't we need to amortize 35,000 a year? Okay? So, how are we going to account for, let's just see what the question was. This one said, what is the consolidated net income attributable to Chamberlain? This one tells us, what is the consolidated net income? Period. So don't we need to take the 498 plus the 285, those are the revenues, which would be 7 783. Am I right? 783. And the expenses are 545. Okay? So wouldn't we take the consolidated revenues? God, what did I say? 783. Right? And the consolidated expenses, 545. And then what's our excess amortization? 35. So don't we need to come, in order to come up with our consolidated net income, take our revenues minus our expenses minus our excess amortization? Right? How you guys doing? Should we start on the problems? You look like you're falling asleep. Y'all ready to start on the problems? Okay, I'm sorry. I just always want to go out of my way to help explain it more. But let's go on the problems. I hear you say sick, forget it. Okay, problems. Guys, the solutions to everything are in the book, even your homework. I added it to your Moodle. It'd be great for you to go over some of them because it will help you understand how to do it. That's what I'm trying to do. Okay? I wish this was more exciting. Okay, number 30. Number 30. This one is dealing with the sale of a subsidiary. What do we know about a sale of a subsidiary? If you retain the controlling interest, do you show a gain? No. If you lose the controlling interest, do you show a gain? Yes. Okay? Posada Company acquired 7,000 of the 10,000 outstanding shares of Sabetha Company on January 1st, 2013 for $840,000. On the subsidiary's total fair value was assessed at $1.2 million, although its book value was $1,130,000. The $70,000 fair value in excess of Sabetha's book value was assigned to a patent with a 5-year remaining life. Okay, so let's just stop right now and kind of go through our equations here. Okay, so let's clear this. Let's just go through these equations real quick. So we've got here, what they purchased it for? The total, let's just go first. The total value of Sabetha was 1.2 and the book value is 1,130,000. So Sabetha, I'm just going to say Sab's fair value, 1,113, is 1,200,000. What's the book value? $1,130,000. What's the excess? $70,000. Now it told us that excess, the $70,000, was a patent with a 5-year remaining life. So this is the patent, and a 5-year remaining useful life amortizes at $14,000 a year. Do we get that? Okay. On on January 1st of 2015, Posada, who's the parent, reported a $1,085,000 equity balance in the investment in Sabetha Company. On October 1st of 2015, Posada sells 1,000 shares of the investment for $191,000. During 2015, Sabetha reported net income of $120 and declared dividends of $40. These amounts are assumed to have occurred evenly throughout the year. How should Posada report the 2015 income that accrued to the 1,000 shares prior to their sale? So how are we going to show the shares prior to the sale? Let me show you. They sold the company on October 1st, right? So basically 3/4 of a year. They had it, right? They had the stock for 3/4 of a year, then they sold it. So if we know that the income from Sab's net income was how much for the whole year? 120. Then we need to take into account that excess patent of $14,000. Don't we always have to do that? And this gives us $106,000 as the adjusted net income. Now, we sold it in October, so if we're assuming this was earned ratably throughout the whole time, 3/4 of this fraction of the year held would be this times 75%, or 79,500 was the amount that was made on the subsidiary up until October 1st. What is our share of ownership? 70%. So 70% Posada's share at 70% is going to be whoops, $55,650, right?
Yeah.
Then what we sold 1,000 shares and we own 7,000 shares. We acquired 7,000 shares and we sold 1,000 shares. So if we take 1 divided by 7, or %, okay? So this figure times this should be the amount that's attributable to the income on the shares we're getting ready to sell. Does that make sense? Yes? No?
What did you times the 14% by?
I times it by the 55,650. How should Posada report the 2015 income that accrued to the 1,000 shares prior to the sale? So basically what we're showing here is if we take Sabetha's income, take away the amortization, take 70% of what we own,